Hi! Join the RHO Trader Group on Telegram. It is 100% free to join, and Robin will be sharing daily market updates and strategy to trade the DLC. Robin will share his trade plans on a daily basis, showing the key levels to take note of. He covers indexes and also individual stocks like Alibaba, CapitaLand, and DBS. This will help you have a better idea on what to look out for, so join the group now. All you need to do is to head down to the description box below and click on the following link. You will be directed to the form, and all you need to do is to key in your email, full name, Poem's account number, and the group that you wish to join, and also to accept the TNC before submitting the form. After submitting the form, you will see this page. Scroll down all the way to the end, and then you will have your Telegram link to join the group. And voila!
Hi there, this is Alvin from Dr. Wealth. Today I have Robin with me again, and we're going to talk about trading the US stock market. So we know that the presidential election is coming next year. The election will happen in November 2024. And there's anomalies during a presidential election, which I just learned from Robin, and he shared with me that, there is a period where it tends to be very bullish before the election actually takes place. So today I want to get Robin to share with us more about these anomalies and how we can make better investment decisions using some of these statistics and trends in the history of the US stock market. So Robin, can you just bring us through the anomalies that you have discovered in this US market?
So let me just start off by saying earnings season. So the earnings season typically, when the year starts, it starts from January. There are 4 parts to it: January to March, April to June, July to September, October to December. Okay, and at the end of the quarter, on the second week, normally on the 15th, they will start reporting. And if you know who is the first one, always to report the result is Alcoa. They are the curtain raiser. Alcoa.
Okay.
Alcoa is always the first.
It's a commodity company.
Correct. Okay, Alcoa. So and then after the Alcoa, you follow by the banks. So very standard sequence of reporting. Okay, so you need to be forward-looking.
Yeah, basically we have earnings calendar, right?
Correct.
There are quite a number of sites that offer that. I think Earnings Whisper. I think even Yahoo Finance have a lot of this calendar of earnings that's coming up.
Correct.
So which means investor or traders should watch out for these.
Correct.
things.
Yeah. Okay. So earnings seasons is a traditionally bullish months. Okay, those are earnings seasons, and then. We also have, if you have heard of this phrase, sell in May and go away. Okay, so those are also months where traditionally the market is bearish and bullish, and in the last 50 years, okay, the period between November and April tend to perform a lot better than the period between May and October. That's why they say, sell in May, go away for holiday until October, come back again for the bull run. So that's so you could see from the statistics here, in the last 52 years, the S&P has averaged a 6.5% gain during November to April period versus a 1.6 gain for the rest of the year, a difference of 4.9%, and Nasdaq at 5.9% and Dow Jones at 6.9% have even bigger performance differential.
Okay.
And you could see even now that we break down by months, you break down by months, you could see that most times they are good. Okay, most times they are good because we all know that the earning reporting season lasts for a long time, So only a very selected few months not so good, January and June and September. Okay, so those are the months that is not so good, and we are in the month of June. Okay, in the month of June, maybe it may end bad. I don't know, but traditionally they are one of the weakest months, and therefore we need to be on the watch out. Okay, so this is the 10-year statistics, and month of January and September tend not to be so good month, right? So that's where all the selling is done, and then you buy it on the dips, and they start selling it in October, December when the market picks up again. Okay, yeah, okay, and go back to earnings again.
Yeah.
Okay, go back to earnings again. So if you have been following the US earnings seasons, right, you will notice that no matter how bearish the analyst is, right, they talk about recession. In fact, even these earnings seasons, right, a lot of people are saying that it's going to be the most scary earnings season, all right, because a lot of high interest rate, the cost of doing business goes up. A lot of companies, defaulting on their bonds. You have the banking issues, crisis issues, and things like that, right? So a lot of people, are saying, okay, this current one, right? But this current one is going to be over, and we have, again, about 70% of company beats the S&P earnings again, right? So I've over so many years, right? I've heard so many very bearish expectations, but most times it doesn't come true. And most times, right, the market will outperform, and the earnings will surprise on the upside. Yeah.
Yeah. So another trading opportunity could be let's say somebody wants to take advantage of the earnings season. They want to long when Alcoa starts reporting the results. Is it advisable to use instrument like DLCs, daily liquid certificates, to long an index, whether it's in NASDAQ, Dow Jones, or S&P, during the earnings season?
Yeah, I think that makes good sense, right? Because I would say even 85% of the time it will be bullish during that period. Yeah, and if you just take a medium-term view, right, sit through the 1.5 months of reporting, okay, and then I think your DLC will do pretty well. Okay. And after that, take your profit, because there's no more catalyst in the sense. Yeah, no more catalyst in the sense, and then all the stocks are back to be at the mercy of market forces.
Yeah.
Again. Yeah.
Okay. Because I also noticed that just now we show that monthly return, right, statistics, right? It tends to be a case where after the earnings season is over, they start to the returns.
Yeah, that's correct.
So it could be a case where the investors really, like what you said, has nothing to look forward to until the next earnings season come again, right? Okay. So that is possibly one method, but don't go short during earnings season.
Yeah. Okay. Never do that. Yeah. Okay. All right. So some of you will probably be wondering, why is it that most times company always beat expectations, right? So there are many reasons, right, that company beats expectation. I have 6 of them for you. First is about managing expectations. So there will be expectations out there, and the more bearish the expectation, the more chances.
Easier for them.
Yeah, easier for the stocks to beat those estimates.
Yeah.
So most analysts, right, when expectations are low, they will even be more conservative. Okay, yeah, and therefore, it's easy to beat when expectations are low, especially in the last 1-2 years, right, when the market hasn't been doing too well. And then the other one is a legal risk. They cannot be too optimistic, all right? If they're too optimistic, it's like overpromise. Overpromise, and people lose money, clients lose money, you can sue them, all right? Yeah. And then the third point is conflict of interest. So conservative estimate reduce perception, bias, or conflict of interest, like front running, the kind of thing. I buy already, and then I tell you it's good. So the kind of thing. Yeah, and also uncertainty and market condition. Analysts lean towards caution in uncertain and volatile market, accounting for potential risk uncertainty. And the other one is the fifth point is analyst compensation. Some compensation structure incentivize low billing estimates for accuracy. Okay, and my last point would be the company guidance. Right, so analysts often align their estimates with conservative company guidance. So most times, you know, they will try to like
Play down the
play down so that most companies in the S&P can beat expectations, and of course, you know, a lot of fund managers, of course, will benefit from it. And then
so on this note, right, sometimes I also observe that when a company beat the analyst estimate, yet the share price can still come down. So what's actually going on in this kind of situation?
Yeah, so some of this, right, the big expectation and share price will still go down. Many of them is because of company forward guidance.
Okay.
Right. So although your numbers looks good, all right, for the last quarter, it beats expectation, but you know, if the forward guidance is not good,
okay,
right? Like for example, you may have less orders, you know, you have less contracts going forward. You know, your sales will be reduced, that kind of thing. So that it may, you see, or in the case where too much expectations have gone into a good results.
Okay.
Yeah, too much expectation. So it's like the obvious.
Okay. It could be a case where the share price already run up before the price, right?
Yeah, precisely.
So it's priced in
correct.
too much.
Priced in too much. That's right.
Okay. So which means it's not just the past quarter earnings, but the forward guidance.
It's
also
very important.
So they need to beat both, right?
That's correct.
Past and the future.
Correct.
Any disappointment anywhere will cause the share price.
Correct. And because the most stocks will beat expectations, and therefore, right, stocks that comes below expectations are punished particularly hard.
Okay. Yeah.
All right, because by and large, you know, if you already have very conservative estimates and then you still cannot beat those estimates, I mean, you are really, you know, your company result must be very, very bad.
Okay, yeah.
So a lot of these companies were bad, right? You know, they take a huge beating.
Okay.
Yeah. So my next point, right, is besides earnings that will affect the share prices of the US stocks, is the presidential election cycle theory. Okay, so throughout history, from the time they captured this statistics from President Truman in 1948 until Biden, right? We see statistics, right, that when the presidential cycle is into the third year, okay, stock market does particularly very well. Particularly well.
Okay.
Yeah. Okay. And the reasons cited has been that president has got, I mean, for the first 2 years, it's like honeymoon year. The third year, he got to hurry up. Alright, pull up the socks if he wants to get elected again. Alright, because the fourth year may be too late already. Yeah. So that is the theory behind. Yeah, and you can see that from the statistics here, all right, going back all the way to 1945, all right, S&P has risen an average of 15.9% during the last full year before an election, all right, compared, we're talking about the third year election, right? Yeah, compared with the overall average of 9.2% for every year, right? And guess which is the best performing president in his third year? It's none other than Donald Trump, right? So in his year, on the third year, the market went up 29%, right? So that's the best, right, on record for the third year.
Okay.
And here you can see that the Dow Jones, all right, the Dow Jones on the third year performs the best. In fact, the performance is quite significant. Okay, you can see on the third year, on average, it's about between 7, year 1, year 2, 5, and 5 to 7%. On the third year, it bumped up all the way to 16. Yeah, if the Republican president tends to go up a little bit more, all right, yeah.
Less so for the other years, but especially on the third year, right? It seems like the Republican president has that Very glaring statistics.
Yes, correct. Yeah. So and we are on the third year, and it's a Democrat.
Yeah.
Yeah. Okay. So this is the greed and fear index, and one of those indicators, right? Indicators that tell us that where the market in the big picture of the macro view is heading. So most times, right, when the greed and fear index is in the extreme greed, which is where we are in now, right? So if you look at the statistics here, right, so this is the CNN greed and fear index. 1 week ago, it was at greed, right? 1 month ago, it was at greed. 1 year ago, it was at fear, right? So it swings like a pendulum, right? Goes from fear to neutral to greed to extreme. But when it gets extreme, right, it means the market is a bit stretched.
Yeah.
So most times you will see that in the last 2 years, right, most times it swings to greed and it doesn't hit the extreme.
Okay.
But so this time is quite special. Alright, it hits the extreme greed,
Okay.
which means, by and large, the market is a little bit stretched. And if you are thinking of, starting to get invested, the greed and fear index is trying to tell you that you could be a little late.
Okay.
Yeah.
Okay. So thank you, Robin, for your interesting take on all these anomalies and sharing your experience how to trade some of these indicators. And I partly think that the earnings season will be one of the most useful, actionable kind of indicators, right? So I still remember you said that don't short the big caps or the US Indices during earnings season. So some of this, I think, really comes from experience and probably we can, what you say, learn without paying for all these lessons for ourselves, right? So hope you like the video. Give us a thumbs up, subscribe to the channel, and watch out for the next one.
Thank you.
Goodbye.
Bye-bye.